Friends, thank you for being here today. What if I told you that the financial security you believe you have is standing on the edge of a precipice, and the ground is about to give way, not in 10 years, but in less than 2? And let me ask you this. If you knew with mathematical certainty that the exact economic patterns which destroyed fortunes in 1929, 2000, and 2008 were repeating right now, would you sit still, or would you act to protect everything you've built? We are living through a unique moment in history, a period of calm before a storm that has been building for over a decade. While the news anchors and financial pundits tell you that the economy is resilient, that a soft landing is achieved, and that your retirement portfolios are safe, the data tells a radically different story. We are not here to fear-monger. We are not here to speculate. We are here to look at the cold, hard math that governs the financial universe, and that math is screaming a warning that we can no longer afford to ignore. Let us begin by confronting the critical window of time we face, because the clock is truly ticking. The central thesis of our discussion today is stark but necessary. A major financial collapse is projected to occur within the next 12 to 24 months, specifically narrowing down to the window between mid-2026 and late 2027. This gives you, the prudent investor, roughly 18 months to prepare. Why this timeline? It is not a guess. We are currently in the final stages of the longest market expansion in modern history. The bull market that began in March 2009 is now entering its 16th year. To put that in perspective, historical expansion cycles typically last between 5 and 7 years. We are now more than double the historical average. The longest cycle before this one lasted 10 years, ending with the dot-com crash of the late 90s. We have exceeded that by 50%. Markets, like nature, operate in cycles. They breathe in and they breathe out. They expand and they contract. What we are witnessing now is an expansion that has been artificially prolonged by easy money and low interest rates, stretching the rubber band of the economy until it is ready to snap. Reversion to the mean, the tendency for asset prices to return to their long-term averages, is not just a theory. It is a mathematical inevitability. The further you stretch the band, the more violent the snapback will be. Now, to understand where we are going, we must look back at the historical patterns, because we have seen this exact scenario before. It is often said that history does not repeat itself, but it rhymes. In the financial world, however, the patterns are so identical that they are practically carbon copies. Every major financial disaster in the last century has followed a specific 4-stage cycle. First, there is excessive optimism, where we see asset prices rising uncontrollably, disconnected from reality. Second, warning indicators start flashing red, yet they are systematically ignored by the experts. Friends, we are firmly in the second stage right now. Third, a specific triggering event exposes the fragility of the system. And finally, fourth, we see a cascading collapse where panic takes over and wealth evaporates. Let's look back at the ghosts of crashes past to understand where we stand today. In 1929, during the Roaring Twenties, optimism was universal. The stock market had risen nearly 400% in a decade. Technologies like the radio and the automobile were revolutionizing life, leading people to believe that it was a new era of permanent prosperity. But beneath the surface, the rot was spreading. Margin debt, money borrowed to buy stocks, had reached 12% of GDP. The yield curve had inverted. Yet, just weeks before the collapse, the most respected economist of the day, Irving Fisher, declared that stock prices had reached a permanently high plateau. He was wrong. The market crashed 89%, 9,000 banks failed, and the Great Depression began. The experts dismissed the math, and the people paid the price. Fast forward to 2000, the dot-com bubble. The internet was changing the world, and investors were throwing money at companies that had zero profits, simply because they had "com" in their name. The Nasdaq rose 400% in 5 years. Valuations were insane. Again, the warning signs were there: an inverted yield curve, record corporate debt, and extreme speculation. Analysts told us that old rules don't apply to the new economy. They were wrong again. The Nasdaq fell 78%, and trillions in retirement savings were wiped out. Then came 2008. We all remember this one. The housing market was invincible, we were told. Real estate only goes up. Banks were leveraged 30 to 1, gambling with money they didn't have on subprime mortgages. Federal Reserve officials assured the public that the financial system was sound and that subprime issues were contained. They were spectacularly wrong. Lehman Brothers collapsed. The S&P 500 fell 57%. And $11 trillion in household wealth vanished overnight. In every single instance, the pattern was the same. Excessive valuation, rising debt, ignored warnings, and then collapse. Today, 14 specific economic indicators are flashing red simultaneously. These are the exact same indicators that preceded 1929, 2000, and 2008. To ignore them now is to bet against a century of history. Before we move on to the hard numbers of today, I want to hear from you. Do you remember the atmosphere before the 2000 or 2008 crashes? Do you feel that same sense of artificial optimism right now, or do you think this time truly is different? Please leave a comment below with your thoughts. I read every single one, and I want to know what you are seeing on the ground. This brings us to our current reality and the undeniable mathematical case for a crash. You might ask, why is today any different? Why can't the market keep going up? The answer lies in the valuation metrics, which are currently at levels that make 1929 and 2000 look modest. Let's look at the Buffett Indicator, which measures the total market capitalization of the stock market against the country's GDP. It is Warren Buffett's favorite measure of market value. The historical average for this indicator is 100%. Before the dot-com crash, it peaked at 148%. Before the 2008 crash, it was at 105%. Today, the Buffett Indicator sits at approximately 230%. Let that sink in. We are not just overvalued, we are in the most expensive stock market in the history of the United States. To return to the historical average, the market would need to fall by more than half. Consider the Shiller-Cape ratio, another key metric for valuing stocks. The historical average is 17. Before the Great Depression, it was 30. Before the 2008 crash, it was 27. Today, it is hovering near 39. Stocks are trading at more than double their historical fair value. When you buy the S&P 500 today, you are paying a premium that has essentially never been sustained in history. But valuation is only one part of the story. The other part is debt. We are currently living in a debt trap of unprecedented proportions. Margin debt, borrowed money used to speculate in stocks, is near $800 billion. High margin debt is the fuel for a market crash. When stocks dip, brokers issue margin calls, forcing investors to sell their stocks to pay back loans. This selling drives prices lower, triggering more margin calls and creating a death spiral. Corporate debt has exploded to $14 trillion or 50% of GDP. Here's the critical problem. Profound amounts of this debt were taken out in 2020 and 2021 when interest rates were near zero. Companies borrowed cheap money at 2% or 3%. But now, as that debt matures, they must refinance. They can no longer borrow at 2%. They must borrow at 5% or 6%. This doubling or tripling of interest payments will crush corporate earnings. When earnings fall, stock prices must follow. And let us not forget the American family. Consumer debt has breached $18 trillion. Credit card debt alone is over $1.2 trillion, with interest rates averaging over 20%. Auto loans and student loans add trillions more. The personal savings rate has collapsed from highs during the pandemic to a dangerous low of 4%. The average family has no financial cushion left. When the recession hits and jobs are lost, the defaults will be immediate and catastrophic. So where does the system break? Let's identify the specific trigger points that are currently cracking under the pressure. A system under this much pressure only needs a single crack to shatter. We can identify exactly where those cracks are forming. The most dangerous ticking time bomb is commercial real estate. The way we work has changed. Office vacancy rates across major cities are sitting between 20% and 30%. Because of this, property values for office buildings have fallen 40% to 60%. Imagine a building that was worth $200 million in 2021 now being worth $100 million, but the loan on that building might still be $150 million, now as the building is underwater. Here is the cliff. $1.5 trillion in commercial real estate loans will mature by 2027. Owners cannot refinance these loans because banks will not lend more than the building is worth. This will lead to mass defaults. This leads directly to the regional banking crisis. It is the small and mid-sized regional banks that hold the vast majority of these bad commercial loans, roughly $1.3 trillion of exposure. We saw a preview of this in early 2023 with the collapse of Silicon Valley Bank and First Republic. Those failures were papered over with emergency government lending, but the underlying rot remains. When the commercial real estate defaults hit in earnest, bank capital will be wiped out. We are looking at a potential wave of bank failures that could rival 2008. Furthermore, the signals of a recession are not just flashing, they are screaming. The SOM rule, a highly accurate recession indicator based on unemployment, has already been triggered. It states that when the 3-month average unemployment rate rises 0.5 percentage points above its low from the previous year, we are in the early stages of a recession. This has predicted every recession since 1970 with 0 false positives. It was triggered months ago. Manufacturing has been in contraction for 2 years. Leading economic indicators have been down for over 20 consecutive months, a streak we have not seen since the prelude to the 2008 global financial crisis. The Federal Reserve is trapped. If they cut interest rates too quickly to save the economy, they risk reigniting inflation. If they keep rates high to fight inflation, they deepen the recession and accelerate the banking crisis. They are no longer in control of the outcome. They are merely managing the timing of the crash. Based on this data, let's walk through the projected timeline of what you can expect between 2026 and 2027. So how does this play out? Based on the data and historical precedents, we can project a likely sequence of events for this unwind. We will likely begin with a phase of denial that lasts through the first quarter of 2026. For the next few months, the markets may remain surprisingly resilient. This is the suckers rally. Optimism will persist despite weakening economic data. We will see corporate earnings begin to miss expectations more frequently, and we will start to hear more stories of defaults in real estate. But the headline stock market numbers may stay high, luring in the last wave of unsuspecting investors. Following that, around the second quarter of 2026, we will hit the trigger phase. The stress will become visible. A specific event will likely shatter the calm. It could be the bankruptcy of a major corporation, a geopolitical shock, or the failure of a regional bank due to commercial real estate losses. Whatever the spark, the sentiment will shift instantly. Stock prices will drop 15-20%. Credit markets will tighten, making it hard for businesses to borrow. By the third quarter of 2026, we enter the cascade. This is where the leverage unwinds. As prices drop, margin calls will go out, forcing investors to sell good assets to pay for bad debts. The selling begets more selling. The S&P 500 could fall another 20 to 25%. By this point, the market could be down 35% to 45% from its peak. Unemployment will begin to spike towards 7% as companies slash costs to survive. We project the bottom of the crash to hit around late 2026. By this time, the S&P 500 could target a range between 2,700 and 3,500 points, a total decline of 50% to 60% from the highs. Unemployment could peak at 8% or 9%. Panic will be widespread. At this point, the Federal Reserve will likely have cut rates to zero and restarted the money printers, known as quantitative easing, in a desperate attempt to stabilize the system. Finally, by early 2027, the dust settles and recovery begins. The market begins a slow, painful recovery. But a massive wealth transfer has occurred. Those who were fully invested in overvalued assets have lost half their retirement. Those who held cash and safe assets step in to buy quality companies at bargain basement prices. However, before we close, we must confront a silent danger that is perhaps even more threatening to this specific audience than the crash itself. The trap of the lost decade and the psychology of denial. Many of you may be thinking, I have lived through crashes before. I held on in 2008, I held on in 2020, and the market always came back. Why shouldn't I just ride this one out? This line of thinking, while understandable, is potentially the most dangerous financial trap for anyone over the age of 60. We have been conditioned by the anomaly of 2020. That was a V-shaped recovery, a sharp drop followed by a nearly instant rebound fueled by trillions in government stimulus. But that was not a normal market cycle. It was a manufactured liquidity event. History shows us that when massive valuation bubbles burst, the recovery is not months, it is years and sometimes decades. After the 1929 crash, it took the market 25 years to return to its pre-crash high. Between 1966 and 1982, the stock market went nowhere in nominal terms and lost massive value when adjusted for inflation. Even more recently, after the 2000 dot-com bubble burst, the Nasdaq took 15 years to break even. If you are 30 years old, you have the luxury of time. You can afford to wait 15 years for your portfolio to recover. But if you are 60, 65, or 70, time is the one asset you cannot print more of. This brings us to the concept of sequence of returns risk. If you are retired and drawing down 4% or 5% of your portfolio annually to pay for living expenses, and the market drops 50%, you are forced to sell twice as many shares to generate the same income. You are cannibalizing your principal at the bottom of the market. This creates a mathematical hole that you can never dig out of, even if the market eventually recovers. A 50% loss requires a 100% gain just to get back to zero. If you're withdrawing money during that decline, you may run out of money entirely. So, why do we hesitate? Why, when the data is so clear, do so many intelligent people walk blindly into the fire? It is a psychological phenomenon known as normalcy bias. Our brains are hardwired to believe that tomorrow will be roughly the same as today. We find comfort in the herd. When our neighbors, our colleagues, and the television pundits are all acting as if everything is fine, it feels socially and psychologically risky to be the one who steps out of line. The financial industry relies on this bias. They invented the term soft landing to keep you calm. They tell you time in the market beats timing the market because their business model depends on you staying fully invested and paying fees regardless of market conditions. But ask yourself, does the captain of the Titanic get credit for staying with the ship, or does the passenger who spotted the iceberg and got on the lifeboat survive? In 2008, the smartest people on Wall Street lost billions. Being intelligent does not protect you. Being prepared does. The refusal to accept that this time is not different is what wipes out fortunes. Do not let the comfort of the herd or the memory of the swift 2020 recovery lull you into a false sense of security. The lost decade is a very real possibility, and for those in retirement, it is a risk that simply cannot be taken. If this analysis has opened your eyes to the reality of the market and you want to ensure you are prepared for what is coming, please support this message by liking this video and subscribing to the channel. It helps us get this critical warning to more people who need to protect their families. In conclusion, I want to leave you with a clear call to action. Friends, the math is inescapable. For the Buffett Indicator to return to its historical norm, the market cap must fall by roughly 57%. This is not a matter of if, but when. However, this is not a message of despair. It is a message of preparation. The difference between financial ruin and generational opportunity is strictly a matter of foresight. You have been given a gift today, the gift of time. You have roughly 18 months before the worst of this storm makes landfall. Your strategy for the next 18 months should be straightforward. First, recognize the reality. Do not wait for the 6 o'clock news to tell you the crash is here, because by then it is too late. Second, start moving capital, rotating out of vulnerable, overvalued speculative assets. Third, reduce your debt. Pay down your leverage, because in a deflationary crash, debt becomes a heavy anchor. And finally, build your reserves. Cash is not trash in a crash. It is king. It is the ammunition you will need to buy assets when they are on sale. Consider safe havens like treasuries or gold to preserve your purchasing power. The crash is coming with mathematical certainty. The warnings are flashing red. The timeline is set. You have 18 months. I urge you to act accordingly. Thank you.